By the year 2000, the seventh largest company in America was a miracle. Fortune magazine had crowned it the most innovative company in the country. 6 years in a row. 15 months later, it was worthless. And the miracle turned out to be an accounting setting. 2 of them, actually. By the end of this file, you'll understand both of them, on the board, in plain language. You'll see the tower that looked solid and wasn't, the boxes where the debt went to hide, and the 20,000 people who paid for it with their retirements. This is vanished billions. Open the file. Enron began as something unglamorous, natural gas pipelines in Texas. Then a consultant named Jeffrey Skilling arrived with a bigger idea. Stop just moving energy. Trade it. Trade contracts on energy that wouldn't flow for years. Enron would become a marketplace for the future itself. The culture matched the ambition. They hired the sharpest graduates in the country, ranked every employee against every other, and cut the bottom of the list every year. They called themselves the smartest guys in any room they entered. Remember that phrase. It has a cost. From the outside, the numbers look like this: revenue climbing, profits climbing, a tower of steel and certainty in downtown Houston. Keep that tower in your mind. We are going to look inside it. Setting number 1, to the board. Ordinary companies book profit when money actually arrives. Enron won permission to use something else, mark to market. Sign a deal today, estimate all the profit it will ever produce, and report that entire estimate as earnings. Today, feel what that means. Sign a 20-year energy contract this morning, decide it will earn $100 million, and report $100 million in profit tonight. The contract has not delivered a single day of energy. The profit is an opinion, wearing the costume of a fact. One deal shows the magic at full power. In 2000, Enron announced a partnership to stream movies into living rooms. Video on demand, 20 years early. The pilot barely worked, and the customers numbered in the hundreds. But under mark-to-market, the future of that deal was bookable immediately, and Enron recorded roughly $110 million in profit from a business that never really existed. The technology failed, the profit stayed on the books. But estimates don't produce cash, and last quarter's booked future is this quarter's old news. So the machine needed new deals, bigger deals, every single quarter, forever, just to stand still. Growth stopped being a goal. It became a survival requirement. Setting number 2, back to the board. All that deal-making needed borrowed money, and debt makes a miracle look mortal. So the debt was moved into partnerships that lived just outside the company's books. Boxes standing off stage, secretly controlled by Enron itself, holding Enron's risks so the tower didn't have to show them. And who ran the boxes? The company's own chief financial officer, who collected tens of millions in personal fees from the very partnerships doing business with his employer. He would later plead guilty and describe the machine himself. The referee owned one of the teams. And out west, a preview of the cruelty. When California's power market seized up in 2000 and 2001, Enron traders gamed the strained grid with strategies they named like cartoon heists, and were recorded laughing about it while blackouts rolled across the state. The tapes surfaced later in a federal investigation. If you want to know what a culture truly rewards, don't read its value statement. Listen to its phone calls. Cracks showed in the spring of 2001. On a public earnings call, an analyst asked why Enron, alone among financial giants, never published a balance sheet with its earnings. Skilling responded with an insult we can't repeat here. Wall Street heard something new in that voice. Not confidence, nerves. In August, Skilling suddenly resigned, citing personal reasons. Days later, an Enron accountant named Sherron Watkins wrote a private memo to the chairman. Her words would become the epitaph of the whole era. The autumn arrived like a verdict. In October, Enron announced a $600 million loss and quietly erased over $1 billion of shareholder value. The regulator opened an inquiry. Old profits were restated, meaning, in plain language, they had never existed. A rescue merger evaporated, and on December 2, 2001, Enron filed the largest bankruptcy in American history. And at the auditor's office, the shredders ran. Enron's accounting firm, one of the 5 giants of the profession, destroyed documents by the trunkload as investigators closed in. Its obstruction conviction was later overturned on appeal. The reversal arrived years too late to matter. The firm was already dead, and 28,000 jobs died with it. Now the human ledger, and this is the part to sit with. As the stock collapsed, ordinary employees found their retirement accounts frozen during an administrative blackout window. They could only watch. In the years before the fall, executives and insiders had sold roughly $1 billion of their own shares. 20,000 people lost their jobs. Many lost the savings of a lifetime in the same month. The verdicts took 5 years. The chief financial officer pleaded guilty and testified. Skilling was convicted on 19 counts and served 12 years. Chairman Kenneth Lay was convicted too, then died of a heart attack weeks later before sentencing. Under American law, his conviction was erased, as if the trial had never finished. On paper, the man at the top was never punished. Paper, as this story shows, has its own way with the truth. And like the scam that rebuilt India's markets, this collapse rewrote America's rules. Congress passed a law that made executives personally sign for their numbers, with prison attached to false signatures. Every CEO's signature on every earnings report since 2002 exists because this tower turned out to be hollow. Set this file at the head of the table because every other file descends from it. A token, a demo, unreachable profits, a statement printer, a warm vault, a paper receipt. And here the original sin, an estimate. Enron did not counterfeit money. It counterfeited the future and sold it as the present. Every fraud since has just been choosing its own costume. So the final lesson on the board is the question that kills every fraud in this series, and it fits in 6 words. Where does the cash come in? Profits can be estimated, staged, printed, and promised. Cash arriving in a bank account is the one number that has to be true. Ask for it. Every time. New forensic files every Tuesday and Friday. The frauds, collapses, and heists the money world would rather forget. Subscribe if you want to know where the money went.